Well, good afternoon, everybody. This is Matador from freetradingvideos.com. As I said before, D7 is going to be out today, taking care of some family things. It's still May 13th, 2009, and I wanted to go over what the market action was today. So kind of nice to have the things that we were thinking corroborated by actual market action. This level of support that we saw in here at the open, and the difficulty of going higher on news like this, where weak retail numbers are sinking stocks. You know, it's all over the news. The sentiment shift is then to the south a little bit, especially again into this overhead resistance on a daily chart especially. But we'll take a look at some of the volume in here, and look at this last little volume print here on a daily chart, still within this consolidation, and there's the close. Alright, so things will shift into an after hours market now. You can see them kind of updating now. But here's the support level. Again and again, bounce, failed that. Watch that happen. I'll show you in a minute. And then that became resistance on the way back up. This whole area in here, support once broken becomes resistance. If you want to fine tune it, that's what I would do. And so that makes a lot of sense. The support level that we were talking about, again, is also pretty good. So this gap area in here. Remember this? So anywhere from this level down to here, this gap, I said the round number of 88 would probably be a good target to look for. We got a little bit of a higher swing low actually out of that, which shows just a little tiny bit of sentiment strength to the upside. We also, at the time, didn't have trend confirmation that we were going to head south, and we didn't have the VIX confirmation until this breakout. Actually, I was watching this happen. This is a pretty good little breakout here. And when that happened, that's when we broke the last little level of support on this daily chart. So that's when they headed south and came back up to resistance, and we're still chopping around. The one thing that you can't really argue with is this massive amount of trend Q reading. This is a major amount of volume flowing into stocks that are declining. The trend itself is 1.22. That's actually considered still basically neutral, anywhere from 0.8 to 1.2, a neutral reading. So there's a big divergence there, but I would be very careful now about going long in the markets after seeing a close like this. Tomorrow we'll need to see if the VIX is going to be heading higher. If we get any news from retailers after the close here, we'll watch and see how the market digests that, see what the overseas markets do, and come back refreshed for tomorrow. But at least the markets acted the way we wanted them to intraday with regards to support level, and that's a great thing. Check out the volume in here. It's not too bad. On a sell-off day like today, when your volume is basically low, or at least normal, there's not too much of a red flag. The only red flag I see at all is, again, this trend Q reading. And that's, yeah, be very, very careful with that. So this could be the beginning of a little bit of a sell-off. I need to see where the next swing low is going to occur on a broad time frame, so I can at least have a better understanding of what I'm going to do intraday. But a consolidation like this, it's really, really good to sit on your hands, kind of watch, try to be in relative strength and weakness stocks. I wanted to answer a question from somebody. It's very difficult to do this by typing it, but W. Workman said, why does the current 200 moving average value seem to be changing depending on the time frame of the chart I'm looking at for a given stock on any given time frame? For example, if I look at the S&P 500 chart for the last 10 days, the 200 MA is currently at approximately 883. But if I look at it over the last 6 months, the 200 MA is currently at 940. If I look at the last 3 years, it'll be 1275. What's going on? Which one's right? I've Googled all over looking for an answer. Can you help? So let's talk about that. And just a quick definition of a moving average. So usually on a chart I print out the 200, they call that big red, the 100, the 50, the 20, and the 13. Those do a pretty good job of putting an array up on a chart. They're almost perfect doublings of each other. I know that 13 to 20 is not perfect, 20 to 50 is not perfect, 50 to 100, 100 to 200, perfect. So I like that. It strips the fluff out of the market. It makes me focus on price first, and just lets me see these fairly powerful indicators because lots of people use them. So a 200 MA on a daily chart is doing nothing more than taking the close, typically, in my case it's the close of the last 200 bars, adding them all up, and dividing by 200. And that will print on the chart right here. The next day, the market will close at a certain specific price. You will then add up those most recent 200 bars, the close of them, right? Add them up, divide by 200, and you'll get a new number, and that will be printed next. The 201st bar then gets dropped. And so it rolls like that constantly. And so if I'm zooming in or out of a 200-day chart, that number will never change if your software is right. So if I look at this, you can see, hey, give me 1 second here. Excellent. I just wanted to show the display update information here. So 9510, no matter how much I zoom into this chart or zoom out of it, it's still a daily chart. Right? So it becomes a 200 daily moving average. Right? 200-day MA. If this was printed on a 3-minute chart, it would be 200 bars, each being 3 minutes long. All right, so let's take a look at how this changes when the time frame shifts. So, right, 9510, I can scrunch it all the way up till kingdom come. It can be so scrunched up, but I'm still going to see 9510. In fact, I can see the 200th bar right here. All right, so 200 bar is right here. That's the first time it can take this information. All right, so I know for a fact that right here back is 200 bars. Kind of cool. If I put more data up, so go to format symbol or whatever, and I look at 5 years of data, but it's still on a daily chart, you'll see that that number didn't change, and I can scrunch that up even more. Now I've got all of this. If I go back in time, of course, I'll find that 200th bar. There he is right there. So this would be the first bar, 1, 2, 3, 4, 5, 6, 7, 9, 10, all the way to 200. That's the first time I can start printing the 200 MA because that's the first time I have enough data to do it. It's kind of cool. So go back out, 9510, 9510, 9510, 9510, as long as I'm on a daily chart. But if I look at a weekly chart, for instance, look where the moving average is now. Well, it's of course going to change because now I'm looking at the last 200 bars close, but it's on a weekly chart. And that incorporates 5 trading periods. All right, so the market's going to change and shift. Right, so this whole thing becomes a gigantic chart in and of itself. But all it is a longer time frame. So now we can see that we ran up nicely, slowing momentum, lower swing high, break of support, resistance, break of this support, and we ate it. All right, some great opportunities in here actually, and that's a broad-looking, long-term time frame. But that chart right there, is the exact same chart on a daily. You could overlay those two together. Right? If I scrunch it up even more, right, you'll see that. See how it matches? There we go. It's the same chart. This one's scrunched up because price pattern is a price pattern. What's different is the indicators, and moving averages are an indicator. So one is not more right than another. To answer the question in a long way, what I care about is when I see something that becomes resistance on one time frame, I know that it will pervade all the way down through the lower time frames. Not necessarily so to my eye on the way back up. If I'm looking at a 3-minute chart, right, here's the 200 MA on a 3-minute chart. If I show that update information, go here, let me just grab that real quick. Right click, grab this, display update. 8962 is a far cry from 9510. Right, but we've already talked about why. So 8962 on a 3-minute chart, if I'm trading intraday, I will watch out for that. But only if I'm trading intraday, and I know that lots of people that are trading intraday are also seeing that and going to react to it. Excuse me, if I'm trading off of a longer time frame, I'm not going to care so much about 8962 because I'm probably not even there watching it happen. If I am, I need to be very, very careful about how I'm managing my long-term positions and not micromanaging them. All right, and so on and so forth through each of these. Every 15-minute chart or an 18-minute chart or a 27.3-minute chart is going to have a different moving average. And what are they good for? They're good to tell me the sentiment of a chart. The same thing I'm learning by seeing swing highs and swing lows through here. Right? That's what matters the most, and then only using moving averages or any other kind of secondary indicator for exactly what they are, secondary indicators to price and volume. So I hope that helps clear up your question. I know it's a long answer to a relatively short question, but I know how frustrating it is to Google all over the place and get nothing back. You just want to, it's like, where's my gun? So, very good. Hope that helps, and good job everybody today in the markets. Fun being here with you. Let me know if you have any comments, any questions in addition to this. If I didn't do a good enough job explaining, give me another chance. And I look forward to talking to you tomorrow morning. Good night, everybody.